When beginners hear about investing, they usually think of stocks first. Companies, charts, rising and falling prices. But there is another massive corner of the financial world that quietly powers economies, governments, and retirement portfolios alike. It is the world of bonds. Bonds are often described as boring. That description is wrong. Bonds are calm by design, and understanding them can quietly make you a much smarter, safer investor. At its core, a bond is a loan you give to someone, usually a government or a large company. In exchange, they promise to pay you regular interest for a set period and to return the original amount at the end. The bond itself is the formal agreement. You become a lender for a while. They become a borrower. The structure is much simpler than most people imagine at first glance. This matters because lending to large, reliable borrowers can produce steady, predictable income with relatively low risk compared to many other investments. Bonds rarely make headlines like stocks do, but they form the foundation of countless portfolios precisely because of their calm behavior. Once you understand how they work, you may see why many wealthy investors quietly hold significant portions of their wealth in bonds at certain stages of life. To understand how it really works, picture three main parts of every bond. The face value, which is the amount the borrower promises to repay at the end. The coupon, which is the regular interest payment you receive while you hold it. And the maturity date, which is when the loan is fully repaid. Together, these three pieces describe the entire life of a bond from start to finish. Let us look at a simple example. Imagine a bond with a face value of $1,000, a coupon rate of 4%, and a maturity of 10 years. As the holder, you receive $40 per year in interest, sometimes split into 2 payments. At the end of 10 years, the borrower returns your $1,000. You have earned interest along the way and recovered the principal at the end. A common mistake is to think bonds never lose value. While the borrower may promise to return your principal at maturity, the bond's market price can move up and down before then. If interest rates in the broader economy rise, the price of existing bonds with lower coupons tends to fall. If rates drop, the price of existing bonds tends to rise. Holding to maturity often recovers the original face value. There is also a hidden risk in lending to the wrong borrowers. Not all bonds are equally safe. Government bonds from very stable countries are usually considered low risk. Corporate bonds vary widely depending on the company's financial strength. Bonds rated lower for credit risk often offer higher coupons to attract lenders. Higher coupons can be tempting, but they come paired with higher chances that the borrower could struggle to repay. A useful way to picture bonds is as scheduled rain. Instead of waiting for one big harvest in the future, you receive regular small drops along the way. Each coupon payment is one drop. Maturity is the final big delivery at the end. The schedule is known in advance. The amounts are usually predictable. That regularity is what makes bonds so attractive for steady income and overall portfolio calm. A second key idea is how bonds fit into a broader investment plan. Stocks tend to grow more over the long term but are bumpy along the way. Bonds tend to grow more slowly but with much less drama. A blend of both can smooth the overall ride. Younger investors often hold more stocks. As retirement approaches, many investors gradually increase the percentage of bonds for stability. A practical example helps. Imagine an investor near retirement. They cannot afford big market swings because they may need to withdraw money soon. Holding a meaningful portion in bonds reduces the impact of a sudden stock drop. The bond portion continues paying coupons. The investor can draw from the steadier side while waiting for any temporary stock weakness to pass. The smoother ride matters more at this stage of life. Beginners often misunderstand the role of bond funds. Instead of buying a single bond, you can buy a fund that holds many bonds at once. The fund pays interest regularly, much like a single bond, but provides instant diversification. If one borrower has trouble, the impact is softened by all the others in the fund. Bond funds are how most everyday investors access this part of the market with simplicity and low cost. There is also a psychology angle. Bonds often feel boring during exciting stock booms. People wonder why they hold them at all when stocks are racing higher. The answer becomes clear during sharp downturns. The same calmness that felt boring earlier becomes deeply reassuring during difficult markets. Many investors only fully appreciate bonds during one specific bad year, after which they never abandon them again. A simple practical rule helps you use bonds well. Match your bond exposure to your time horizon and tolerance for swings. The closer you are to needing the money, the more comfort and predictability you usually want. Use diversified, low-cost bond funds rather than guessing on individual issuers. Keep track of how your overall mix of stocks and bonds shifts over time, and adjust calmly when needed. There are things to avoid. Do not chase the highest coupon without understanding the borrower's strength. Do not pile into bonds you do not understand. Do not abandon bonds entirely because stocks are doing well. Do not forget that bond prices can move with interest rates. Do not assume long-term bonds are always better than short-term bonds, since longer maturities often come with greater price sensitivity to rate changes. A better habit is to think of bonds as the calm foundation of your investment portfolio. They may not produce the most thrilling returns. They may not double in good years. But they often hold steady when other investments are noisy. A small allocation, well chosen, can reduce stress meaningfully. Calm portfolios are usually held longer. Held longer, they compound better. Sometimes the boring tool is exactly what makes the rest possible. Over the long term, bonds quietly stabilize wealth across many decades. They provide income during retirement. They cushion portfolios during stormy market periods. They allow investors to stay calm when others panic. They are not glamorous. They will not appear on exciting headlines. But many of the calmest, most successful long-term investors have quietly relied on bonds as a steady, dependable partner in their financial life. So here is the short version. A bond is a loan you give to a government or company in exchange for regular interest and the return of principal at maturity. Bonds have face values, coupons, and maturity dates. Their market prices move with interest rates. Higher coupons often come with higher risk. Bond funds offer easy diversification. Bonds add calm, predictability, and balance to long-term investment plans. If you have never owned a bond or a bond fund, learn about the options available in your country. Consider a small allocation appropriate to your age, goals, and comfort with swings. Use low-cost, diversified options where possible. Adjust gradually as life moves forward. Bonds may not be the most exciting tool, but used wisely, they often become one of the quietest and most trusted parts of a strong financial life.